Hello and welcome back to the podcast. This episode, we are joined by Mr. Jim Bertram, chair of Keyera Corp, a TSX-listed midstream company with a market cap of approximately $10 billion. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. This podcast episode is brought to you by EPAC, the Explorers and Producers Association of Canada. Good morning, Mr. Jim Bertram. Thank you very much for doing this. I really appreciate your time.
Trevor, excited to be here.
It's an honor to talk to you. For the listener, you were the co-founder of Keyera Corp, or Keyera for short, but to get it right from the top, or the source, what is Keyera?
Well, Keyera didn't start off as a Keyera. We started off as Gulf Midstream. Dave Smith and I call them co-founders, spent a lot of time together in Gulf and Indonesia. And with all the extra time together, we talked about the assets that Gulf had and maybe weren't using. And at the time, Gulf was looking for a way to reduce some of their debt. And we said, look, we could pull some assets out of Gulf and set up a separate company or sell these assets to a midstream company out of the U.S. And we got clearance from our CEO at the time to look into it. So we probably spent a year and a half to 2 years just getting the assets ready to pull them out of Gulf, which was maybe the hardest part of the whole deal, was just the disconnect from the gathering and processing assets and Gulf's production, as well as the marketing business. And so after 2 years, we were ready to go, but we weren't happy with the proposals that were coming to us from some of the U.S. midstream companies that wanted to get into Canada at the time. So we convinced the Gulf executives to let us become an income trust. So the step before that is we brought in Keyspan out of New York City. And we ran this probably for 2 years as Gulf Midstream Services. It was 50-50 sort of joint venture. Keyspan eventually bought the second half of these assets from Gulf and ran them for probably another year and a half, 2 years. And then they said, guess what? We're a 100-year-old utility and we have a chance to buy some more utilities in the Boston area. So we're going to sell you guys. And that's when we convinced Keyspan that if they were patient, turn us into an income trust. And at the time, income trusts were very popular. And so we went public with these assets in 2003 as Keyspan. And within probably another 18 months, did a couple of secondary offerings, and we're 100% owned. And we said to Keyspan, so long. We're now a 100% publicly traded company. And at that time, they said, great, glad we listened to you, but we need our name back. So we had this great listing on the Toronto Stock Exchange, KEY.UN. So we said to our employees, we need a new name, but it's got to start with Key because we want to keep the listing. We had a contest. Winner was going to get a weekend for two in Kananaskis, and somebody's wife came up with Keyera, and that's how we became Keyera in just after 2003 when we became public.
And for the listener, Keyera and the original assets were a series of pipelines, storage facilities, gas gathering systems that help transport and store hydrocarbon products.
That's right. Our model from the start was sort of wellhead to burner tip. So the gathering of raw gas behind our gas plants, the processing of that gas, the splitting of the marketable gas from NGL assets, the NGL mix, and then taking that mix into Fort Saskatchewan where it could be fractionated and then either stored in caverns or moved through pipelines to market or truck or rail. So we kind of jokingly said, if we own all that value chain, it'd be $2, $2, and touch that molecule as many times as you can. And that was sort of the basis for these assets. And when we came out of Gulf, we chose some of their bigger plants, Strachan, Rimbey, Brazeau, that had many producers behind it. And, the business model was, as a producer, you're not really encouraged to be accommodating to your competitors behind your plant. But as a midstream company, everybody behind our plant was going to be a customer. And so we started acting that way. We had customers instead of competitors. So the 300 people we brought with us from Gulf, we had to sort of indoctrinate into a new world of, hey, treat these people like your customers, where maybe some of our joint venture engineers had spent decades competing with them. So, but our business model was going to be, sort of wellhead to burner tip, try to touch that molecule. And we also at that time said, we want to be west of the fifth meridian. I think if you think about it, 25 years ago, we said that's the future of the basin. It's going to be deeper. There's going to be more liquids in the gas stream, and we got that one right.
Maybe we'll get into Keyera a little bit more and
Sure.
how it all started and whatnot. But before that, to go back to the start, maybe the early
Okay.
days. Originally, I think you started in a small town in Saskatchewan.
Yeah, I was born in Maple Creek, which is just down the road, a few miles from Piapot. Grew up in a very modest environment. And, it's very much a farming, ranching community. So spent a lot of time working on my uncle's farms and didn't have much going on except baseball in the summer and hockey in the winter and a little bit of school in between.
Then you got into hockey. You were pretty good at hockey. I think your plan or you tried to get into the NHL?
Yeah. Well, back in the late 60s, early 70s, there was only 6 teams in the NHL, but I was really interested in hockey, but I never got a chance to play it in Piapot. It was an outdoor rink. Some winters we got 5 months of good ice. Some winters we got 2 months of good ice. So I actually didn't get a chance to play hockey until I was 13. And my dad would drive me 22 miles to Maple Creek to play, and that was the first year of Bantam hockey. And I liked it, and I was big and strong for my age. And 3 years later, I was playing junior hockey. So maybe I lacked a few of those great skills you get from playing hockey at age 6. But I spent 4 years playing junior hockey in Alberta, the last 3 in Medicine Hat for Medicine Hat Tigers. And you know what? At that point, World Hockey had been around for a couple of years, and they were merging the NHL and World Hockey. And I made a decision that my limited skills should push me someplace else. And I went to university and was fortunate to play university hockey for 4 years while I went to school at the University of Calgary.
You also played in Germany for a little while?
After that, I spent roughly a season over there. Knowing it was going to be my last year of hockey, I just thought I was my reward for 8 or 9 years of competitive hockey. But I knew I was coming back into the industry.
And you made the decision that the NHL probably wasn't in the cards.
That was an easy decision. I looked, I just said, look, here's my skill set, here's my size, and time to move on. I love hockey. I loved it a lot, but you have to be realistic as well.
Went to school at the U of C.
Yes.
And was the goal to get into energy? What were you thinking when you graduated?
No, hey, coming from Saskatchewan, playing hockey, I'd probably never met anybody up to that point in my life that actually sat behind a desk and worked in business. But I did take business because somebody convinced me that was the degree to take if you didn't really know what you wanted to do. And but one of the coaches at U of C was a fellow named Gord Cowan, who worked at that time for a French multinational company, Aquitaine, and he arranged to have a couple of us come work the summer my last year. So I did that and sort of fell into a job and fell into a career.
And so when you graduated, what was your first real job after that?
Well, my first job for the first year of my career at Aquitaine, which quickly became Keyera through an acquisition, was working in the human resource department. So after a year and a half of that, I said, I don't know if I'm very good at this. And I convinced the senior people at Aquitaine or Keyera to go into the corporate economics group. And that was a big break for me to go in there and really got my arms around what was happening in the exploration side of the business and the production side of the business, because I was running their economics, and opened my eyes to a lot of stuff. And so I probably spent 4 years in that business. And then about the same time as the whole oil and gas industry was deregulating in 85, 86, I went into the marketing group at Keyera. And that was a big break because, up until then it was government regulated, and with deregulation, it was kind of the Wild West in terms of every producer now got to market their own oil and gas and NGL. So I started to learn that business from the ground up, which I just built on as I moved around from company to company in Calgary.
So throughout your 20s and into your 30s, you were just thinking you have a good career in marketing, more or less?
That's kind of it. I didn't have any aspirations of being a CEO. That was never land. But I got good exposure. I went from Keyera, which was a big company, to work for Poco, run by Al Markin at the time. So, they were moving and shaking, and it was an exciting time over there. And spent a couple of years there, and then I ended up working for a U.S. company in Canada, Amerada Hess, which is the Hess company just recently got sold to Chevron. And, I was hired by John Hess in an interview in downtown New York City and came out here. And I was a one-man team at Hess until we grew that business and ended up as their vice president of marketing, and probably spent 8 or 9 years there and really got my hands into the marketing world, but also into the operations, because we had a number of gas plants, and I was trying to connect what was going on in the field with the marketing business. And that was a tough company to work for. They're very, very demanding, and I learned a lot. But John Hess was, like Al Markin, were good leaders that you can learn from. So we got bought out by Petro-Canada, and my choice was to go to New York or Houston with Hess, or stay in Canada, and I chose to stay in Canada. And about 2 weeks after that, Gulf came along and offered me a job to head up their marketing group, which at the time was probably the biggest marketing group in Calgary, because it was a big company. We were marketing all the Crown barrels on the oil side. So went there for a couple of years as vice president of marketing, and that's where the concept of a Midstream company came about.
And before the legislative change, the government used to control the marketing? How did that work?
Well, they used to, is very controlling, and producers weren't independent to sell all their products, gas, oil. And, the deregulation just resulted in the industry really taking off, because you could only market what they marketed. And especially with gas, with the deregulation, everybody was racing down to Ontario and Quebec to sell gas directly to the end use customers, and moving that transportation on TransCanada. And it really opened up the market.
So before the deregulation, the government would oversee the buying and selling?
Basically, it was kind of before my time, and I never paid a lot of attention to it, being in the corporate economics group. But basically, it was very government regulated out of Alberta and out of Saskatchewan. Yeah.
And for the listener, when we say marketing, it's not like advertising
Yeah.
of hydrocarbons. It's
Selling the products, taking that natural gas and moving it through pipelines to end use markets, taking the NGLs out of the fractionator and moving them to end use markets, and same with oil. Your heavy oil on different pipes to different refineries, around North America. You really followed that molecule to the end.
so through the 80s, and then I guess that would have taken you to what year did you start at Gulf?
Gulf was probably about 96, 97 after the sale of Amerada Hess to Petro-Canada.
And you were working, just trying to pay the bills and see where it went?
Raising kids, paying the bills. Gulf was a big job. I had the gas group, which was by itself was a big group. The oil group was separate and big, and we had NGLs. And at that time, Gulf was a partner, and I sat on the board of Alliance Pipeline on behalf of Gulf. So we're moving sulfur to markets as well. So, I had probably 100 people reporting to me, and a lot of people that knew a lot more than I did about oil marketing, gas marketing, and NGL marketing. So it was a great opportunity to be managing these people, but to really learn from them as well.
And while you were at Gulf, you met your co-founder, Mr. David Smith.
Dave Smith, that's when Dave rode into the picture. He was in the finance group, and, Gulf at the time had some really interesting assets in Indonesia. We were finding gas on the island of Sumatra, but the biggest problem was there was no market for this gas. So the president said, Jim, get over there and try to figure out what we're going to do with all this gas. So at the same time, Gulf was thinking about taking their assets in Indonesia and turning into a separate company, Gulf Indonesia, which they ultimately did. But Dave was working, I think he was working with Goldman Sachs at the time on doing that. So him and I ended up often on an airplane to Egypt or to Indonesia or meeting in Indonesia. And, through probably the course of a year, we spent a lot of time together and started talking about a midstream company because I thought about it and felt like Gulf really had some wonderful assets like these gas plants I talked about, Strachan, Rimbey, Brazeau, Nordig, that they weren't doing a lot of drilling behind it. And these plants were started, and others were. There's lots of other smaller independent producers out there. And at the same time, we had fractionation and cavern storage at Fort Saskatchewan, some critical pipelines between Edmonton Terminal and Fort Saskatchewan. And as I started to understand those assets, I really felt like we had a good chance to start a midstream company here.
The assets were owned by Gulf, but weren't being utilized to their full potential, maybe one way to put it?
That's a great way to put it. And they were not owned 100%. Rimbey gas plant, when we first took it into the midstream company, we only owned, I'm going to say 39 to 40%. We had 14, 15 other owners, Chevron being a big one. Fort Saskatchewan at the time was actually operated by Chevron, and we were the second largest partner there. And we were always sort of stymied by what we thought we could do because of the operator. The operator had a lot of the control, and Esso was also a partner in that. So a lot of these assets had multiple joint venture partners. And so part of our strategy would be to try to get as much ownership as we could. And in some cases, we ended up owning 100% of these assets, but it took a lot of time to do that.
So the original value proposition for the assets was that you guys would take over them, utilize them more, and as a result, generate more revenues.
We would be customer friendly, and we could build pipelines into new areas to fill up these plants, whereas a producer was never going to spend his capital that way. We felt like these assets would result in a cash flow stream that was much more stable than the volatility of an oil and gas company at the time. And so we'd probably get a better multiple in the market. And that's what we did. We started to build gathering systems, add new plants, take out our partners where we could. Now, our probably first big break was Chevron had a midstream company called Enerpro, and we were successful in buying that when they put it on the market. A few years after, we're still Keyspan at the time, but shortly after we went public, we had access to capital, and we bought this asset, which was Fort Saskatchewan frac and storage, the other big chunk of Rimbey pipeline and Rimbey gas plant. And when I look back, we stole it. I mean, the thing that was interesting at that time is that we could realize more value than the producers because they looked at their assets and said, we don't have any real new gas coming into this plant, so what's the value of it? And, we were out there with a balance sheet and ability to raise equity, and we just started buying up producer working interest and smaller plants west of the Fifth.
You kind of aligned it at the start, but originally when you identified the assets to Gulf, how did you present it to them? What was the next step? Did you have to?
Well, it wasn't always that easy to get out of Gulf because one, the president that was there at the time, they needed to buy down their debt. They had too much debt. So that was the opportunity. Without the debt problem, this probably wouldn't have happened, and Dave and I talk about that. But there was an opportunity and we took advantage of it. And we said, we think we can get you $500 million if you let us roll in enough assets and take it public. And so that sort of determined what assets came in. And, we had to go out and, sort of work internally to get processing fees for Gulf because they were going to be our biggest customer out the door. And we were going to market all their gas and all their NGLs. So we had to basically go through the exercise and sort of look into the future and say, well, what kind of cash flows is this company going to spin off? And what's the value? And how can we sell the value to a partner? And so we went through a process and Keyspan came out of New York. We didn't even know what a Keyspan was. They turned out to be a 100-year-old utility out of New York City, out of Brooklyn. And so as they bought the 50% and we proceeded on, we eventually got a little more sophisticated and we convinced the guys in New York that this was a good business model. Bob Cattell was the president and CEO of Keyspan, pretty dominant player in New York City. And he loved the business model. And so when they bought the last 50%, we were off and running. Now we had a partner, but little bit of an issue in that, Brooklyn Union was a utility, and utilities have a risk profile that's a little different than what we were presenting as a midstream company. So after a couple of years, they had a chance to buy some really interesting assets around Boston, 2 or 3 utilities, Boston Gas, Essex Gas, and they needed the money that they'd get from taking us public, and that's how we became public in 2003.
It's hard to imagine nowadays after being CEO and chairman of Keyera, but at the time, was it a big leap for them to allow you to do this?
Well, there was a huge leap because, Dave knew the capital markets side and was obviously very smart, understood what was going on inside golf. And, without Dave's execution, this might not have happened. But, I was the sort of the dreamer. And so we were putting, we put these assets originally together with the idea of selling them. And Dave and I weren't under any idea that we were going to run them. It was just we were working on behalf of golf, even on our way out of golf. I still had a golf hat on and a golf midstream hat on, and so did Dave. And we were trying to be fair about what we could put back into the shareholders of golf at the same time as have an entity that somebody'd see some value in and pay us top dollar for. So on the way out, Dick Auchinleck at the time, sort of said, okay, guys, what do you want to do? Do you want to stay in golf or go with the assets? And I said, I'd actually prefer to go with the assets. That's where my work is and my love. And Dave was the same way. And he said, okay, Jim, you're going to be the CEO. And Dave, with his finance background, is going to be the CFO. And I always joked that I had to be CEO because I would have been a brutal CFO. And so we kind of fell into those jobs and fell into that world. And it's pretty exciting.
So you would have been 30 something at the time? Was it a big risk?
Yeah, well, it was probably a big risk for the assets in golf, but for me, it was like, hey, this is a venture. And yeah, I had kids and mortgages and all that good stuff, but you know what? It was very exciting. It was very exciting. Because you know what? I think we were the first out the door with that business model. AltaGas was around, but we were going to be different than Transcan and Enbridge because we were going to have a commercial bent. We said we're going to be the most commercially savvy midstream company in Alberta. And I think we were. And some days I think we're still very much driven by the commercial aspect of the midstream business.
This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This podcast episode is brought to you by JSG Professional Services, Canada's trusted leader in pipeline construction management and inspection resources. JSG provides competent, qualified, and verified pipeline construction management and inspection resources, supporting Canada's largest pipeline companies from initial development through final execution. Whether your project involves new pipeline construction, integrity programs, maintenance, pump stations, compressor stations, or inline inspections, JSG has consistently delivered experienced professionals to Canada's energy industry. JSG proudly supports Canada's energy infrastructure with competent, qualified, and verified pipeline construction management and inspection resources. Visit jsginc.com for more information. Keyera went public in 2003?
That's right.
Do you remember the day you guys went public, and did you celebrate?
I think Dave passed out because he'd gone about 3 nights without any sleep. No, I don't remember a lot of celebration, just a big sigh of relief. We realized that it's one thing to have a strategy, but now it's time to execute. And I think we all felt a little nervous about it, but off we went.
And so day one of a public Keyera, do you remember those days?
Yeah, I remember because, now, an RBC was a big part of that, but we didn't have any analysts following our story and starting to meet potential shareholders and getting on the road and selling the story. Hey, I was all new to me. I think Dave had seen some of that through some of his previous experiences, but no, it was all new.
And the idea was you still needed money and you had to sell the story. Was it a tough sell?
Well, I think, it was a business that people didn't really understand. And, we had to try to simplify, the old elevator 30 seconds to make them understand it. And they understood the E&P business, and they understood maybe utility and the pipeline business, but we were kind of in the middle. And I think we certainly sharpened up our story after as we got going. And one of the things I recall is we didn't have any. RBC had promised they're going to have an analyst on our story, but they had an individual wasn't moving very fast. So, here we are out 6-8 months into our being public, and we're getting ready to buy or try to buy Chevron's midstream assets. And we didn't have any analysts following our story, and we're going to go out and try to raise money, but nobody knows about us. But we managed to convince our board to go after this asset. And we heard after that we were very, very lucky. We didn't get it by many dollars, but it was the first big, I'd say, transaction that we did that really made a difference in our world, because now we had control and operatorship of Fort Saskatchewan, the caverns, the fractionators, the pipelines, and then everything took off from there.
Do you remember who did your first equity raises that maybe kind of took a risk on you, like Peters & Co. or somebody local?
I remember we had Peters & Co. Working for us.
Mr. Mike Timms?
And we wanted Mike Timms. It was kind of funny. We had other banks wanted to be involved, and even RBC, who ultimately was behind all our equity raises and debt raises. But we absolutely said, somebody's got to come into the room and say this is a good transaction. And Michael Timms comes in and does that. Peter Lougheed and the other board members are going to go, if it's good enough for Mike, then it must be a good transaction. And we had, obviously, people like Peters worked very hard on this, but Mike came in and, he got his arms around it and came into the boardroom and said that this looked like a really good step out for us at Keyspan at the time, and got board approval. And Dave and I think we joke, we're still going up the elevator in terms of what's the right number to put on this Enterpro asset. And I think he wrote it in at the top of the elevator, because we did a lot of debating back and forth. We always joke that we came from two different worlds. I got the smart guy from Harvard and this hockey player out of Saskatchewan with a BCom from U of C. Mm-hmm. But that asset was, I think, one of the big turning points for us.
BCom from U of C and maybe some sharp business skills that can't be taught.
I would say my first degree came playing 4 years of junior hockey at the back of the bus, and understanding how to get along with everybody and how to get out of bed after you've had your butt kicked the night before, and perseverance, I guess, and hard work. But yeah, I think I often draw on that. And when I was CEO, often I felt like a coach. Sometimes you gotta be a cheerleader all the time and be positive and try to understand everybody that's working for you. And every once in a while, you gotta I used to say to Dave, got to kick the garbage can around the dressing room, get everybody's attention. But that didn't happen very often.
And somewhere along the way, Peter Lougheed ended up as chairman at Kiier. How did that happen?
Well, Bob Cattell and Peter Lougheed were really good friends. And Bob, of course, as president of Keyspan, ultimately was our boss. And so when we went public, Bob asked me if Peter Lougheed could be our chairman. And I said, are you kidding me? I would love to have his wisdom. And Bob and Peter had become friends years before that, when Bob Cattell came out to Alberta looking for gas to move all the way down TransCanada into the New York City area. Couldn't get gas up from the Gulf Coast. So he came to Canada and he met Peter Lougheed, and Peter opened doors for him. And that was the Iroquois pipeline was built. And there was, I think, gas went down into that area for 20 years on the backs of that relationship. So they'd had a long relationship. So that's how Bob, asked whether Peter could be our chair. We were very fortunate. I mean, that gave us instant credibility. Peter didn't get into the business in a deep way, but I think he told me he had been on over 30 boards at that time. So he knew the boardroom, ran great meetings, had great respect from obviously the executives and the other board members. And it was a good time.
You were CEO of Keyera for roughly 16 years?
Well, I was, I guess president before we became public, and then up to about 2015, when it was time to step back and let Dave Smith have a crack. And, Dave was such a loyal employee and smart, worked hard. We'd had a little discussion, and I said, hey, I always felt that Dave could go work for our competitors anytime he wanted to. And I said, if you hang in there, I'll give you a chance to be CEO. And I was, I don't know, just over 60. And I went to the board and suggested it. And they kind of said, well, why would you want to step back? And I go, well, there's a lot of work to come out of golf and a lot of work to get this thing going. And I think at the time, we continued to grow, and it was just time. And so I stepped back, and they said, well, will you stay on as chair? Because Peter had passed away at that time. And I said, I'd love to. So I stayed on as executive chair for a year, and Dave had it under control, and I stepped back and was just chair. So
Not many people remain CEO for that long. What do you think allowed you to stay in that position?
I just think I had a good team. I had good people. None of this would have been, the success would have been possible without all the great people that I picked up along the way. And, I was smart enough to understand the business and try to guide where we wanted to go. But I also got out of the way of people like Dave Smith and Dean Setaguchi later on. But we had good technical people. We had excellent people running our gas plants and running our fractionators. And I always felt, sort of a Saskatchewan, I'll call it a farm boy. I could relate to the field people, and I loved going to the plants and loved going to Edmonton, Fort Saskatchewan. These are the people that were making the money and making the difference. It was their attention to our customer that really made us, I think, really differentiated us. But I always, had a soft spot for the marketing group, because even when we went public, the bankers weren't crazy about bringing the marketing group along. They knew there was volatility there. But I really felt that bringing the marketing group along, and I convinced Dave that this was going to differentiate us. And we were working with the producer to get gas in our gathering systems and then process it. And then at these plants, you had the NGLs, and we were there to tell the producer, we can manage your NGLs into Fort Saskatchewan, fractionate it, get it to market. And the real test is, what we can flow back to you in terms of a net back and make it seamless as possible. And most producers at the time, they understood gas, they understood oil, but NGL and sulfur world was kind of just somebody else managed that for them. And so, I think we just had good people, and we had outstanding marketing people. And, we started making pretty good money in the marketing business, but there's volatility. And, to this date, you have to explain that volatility to your shareholders and the analysts. But when you can make $200, $300, $400 million a year from your marketing business, I always joked it allowed us to make some mistakes on the other side of the business because it was cash coming in every year.
When Keyera went public in 2003, market cap of the company was approximately $500 million. Now it's about $12 billion. Do you remember some key decisions that helped shape the value drivers for the company? What did you pay attention to?
As I said before, I think deciding that we were going to focus on west of the Fifth, was big, because any assets we bought in the field were west of the Fifth and what we thought were liquids rich, a lot of that in the Deep Basin and foothills. I'd say the second big decision we made was buying Enterpro. It was a big decision. A few years later, we bought Chevron's and Neste's interest out of Alberta Envirofuels. So this is a plant in Edmonton that took 20,000 barrels a day of butane and made 14,000 barrels a day of isooctane. And Chevron wanted out of the business. We realized we had a huge position at Fort Saskatchewan. After taking over that asset from Chevron, we started to mine more caverns. So we started with 10 caverns and maybe 7-8 million barrels a day of capacity. And as we grew that, we realized that it made a lot of sense for us to buy the isooctane business as well. Didn't know much about isooctane, but we knew a lot about the butane inputs. We bought that, I think, from Chevron and Neste for, I say a song, because there are some years we probably make as much money as we paid for that asset. But they weren't utilizing it. They were moving all their isooctane, which is a fuel additive. When you probably drive a hot car, so you need that high octane gasoline. That's some of Keyera's isooctane in there. But they were moving it on Trans Mountain Pipeline. It was being apportioned. Their plant was only producing it at half capacity. They were going through a cycle where butane prices were quite strong. And Neste in Finland were off on a different, I think, renewable kick. So we walked in and bought it. And immediately, within the first year, we said, why can't we get all this product into a market? And, at the time, we were loading thousands of rail cars a year in propane and butane and offloading condensate. We realized that, hey, we can put this isooctane onto a rail car and we can take it anywhere in North America. So a couple of years out, we're moving isooctane to the Gulf Coast and picking off all these refineries and turned this into a wonderful business, and that it is today because of the logistics expertise that we had.
You were able to find some assets with low-hanging fruit on them along the way, but there's other eyes on the market as well. Was it competitive, or did you just find the assets
Well,
first?
that one there was only maybe one or two other players that might have looked at it. And, we always prided ourselves in keeping our balance sheet ready to go. And this was a downturn in the market. And we felt like we could make a step out on that one. And we did. And it was the right timing on it. I'd say some of the other big things we've done that's really made a difference is we decided early on that the Montney was real. I pride myself in staying tuned into the oil and gas producers in town. They're a tremendous group, and I've spent 20 years getting to know them all, as many as I could, and spend time understanding their plays and what they saw. And, we realized, we watched with interest the Duvernay take off, and even the Montney was first, but the Duvernay wasn't far behind it. And we watched land sales and we watched what people are paying. And I still look every day at where people are licensing wells behind our plants. And we got into the Montney and we bought a plant, built some pipe, and then realized that it was real. And we've built 2 plants in the Montney. So we've got, close to a BCF a day of processing capacity in the Montney. And then, 5 or 6 years ago, we all knew that someday we had to build a pipeline right through the guts of the Montney and the Duvernay to compete. But it was always tough, is it going to be an expensive pipeline, and getting producers committed when they don't know how much liquids they're going to have. And, I think at that time, the technology was still being tested. And if we knew then what we know today about the Montney, we'd have built that pipeline so quick. But there was a lot of risk associated with it. We made a tough decision, and people often tease me. My producer friends always tease me that the midstreamers don't take any risk. Building CAPS pipeline was quite risky, and especially when we got caught with COVID in the middle of it and had to shut down for a while. But, a $1.5 billion pipeline had ended up being $2 billion. But, our guys did a heck of a job just bringing it in. We were competing with Trans Mountain TMX at the time, which everybody knows what that turned out to be in terms of costs, as well as a coastal pipeline. So CAPS was a big, tough decision for us, which is going to pay off for the next 20 or 30 years.
So do you remember when the Montney started to take off, maybe early 2000s, and you think to yourself, I really need to get involved with this area?
Absolutely. Absolutely. And I remember I was a chairman at the time, and I remember saying to some of our guys, hey, if we don't believe in the Montney and if we don't get some plants into the Montney, we might as well get out of the business. We've always had the ability probably to put ourselves up for sale because we had such strategic assets at Edmonton, Fort Saskatchewan, but we realized that we had to be there. And today, I think we're still, I don't know, maybe second or third inning into the Montney, and probably less so into the Duvernay. So absolutely excited by that. But we also said, look, the fallback building CAPS pipeline through the Montney and the Duvernay is that this is the deep basin. At $3 gas, you're going to see and with today's technology, I think the deep basin has some of the other zones in there, the Falher and Spirit Rivers and Cardiums, and just follow the tourmalines and the CNQs and the ARCs and all the little guys that are in there. You'll see what it could be. It's not just the Montney. There's just a lot of gas to come out of that basin. And in my mind, we haven't really even gone after the gassy part of the Montney, which we like because it's the liquids that we're very interested in. But Canada's got a lot of gas to bring to market.
So when you approached the producers and said, I'd like to handle your gas, how does that work? Because there are other midstreamers that also like to handle that gas.
We always say we've made this basin competitive, and we think that it's in the producer's best interest to have competition. We have some tough competitors out there, and we welcome that because it makes us better. The good news with the Montney and the growth in liquids is that people appreciate the value of the assets at Fort Saskatchewan, but also, here we are today with producers building their own fractionators because they might want to take some of those propane barrels or butane barrels to the West Coast. And you got AltaGas that's been really prominent and got great assets there in the business. Today over 100,000 barrels a day go out the West Coast. And when I look in my crystal ball, that could be 2, 3, 4, 5 times. I mean, the Asian market is there for anything I think we can give it in terms of natural gas liquids, oil, or LNG. And I just think we saw that. When we go to the producer, I mean, it's customer service. We want to be ready. Firstly, you want that processing plant to run at high utilization rates, and then you want to be able to get their liquids into marketable locations like Fort Saskatchewan and price. At the end of the day, they want to know what they're going to get for their propane, their butane, their condensate. And I think we have a good track record. But there's lots of good competition out there. There's 4 or 5 little new midstream companies that are building fractionators and are sharp marketers. I think the market today for propane, butane, condensate's never been more liquid in terms of customers and competitors for us. So it's a good, healthy market. The other thing that we did that really made a difference is when the oil sands were starting to build out, everybody was buying up land in Fort Saskatchewan was going to build their own upgrader, and there was going to be 5 or 6 upgraders, and everybody was going to manage their own condensate for diluent to move the bitumen through the pipes. We really believed that wasn't the right model, that eventually we already had lots of cavern storage, and we started to convert a number of our caverns into condensate storage, and we got connected into the other fractionators, even the competitor fractionators, and we got connected into Cochin, connected into Southern Lights. So we got basically connected into everything that could bring condensate into the Fort Saskatchewan area. And then we got connected into the 4 or 5 takeaway pipelines, one of which we were partners with Enbridge. But we basically had the most liquid condensate market. One customer could be wanting to put 30,000 barrels a day into cavern capacity, and another customer wants to take it out to move it on a pipeline up to blend. So today we probably touch 500,000 barrels a day of condensate for our customers. So I wouldn't say we're the only ones that can do that, but we put in place the easiest, most transparent model, and we call it our condensate hub. So it's possible for a producer to put condensate into a line on caps now and get that barrel back at Fort McMurray, where he puts it into and blends it and moves it down one of the pipes. So that differentiated us on the condensate side. And then when we bought AEF, we became the largest buyer of butane in the province. So we're a big consumer of NGLs as well.
And how does Keyera support the companies in a time of weak pricing? How does that aspect of the business work with sub-dollar natural gas?
We went hands-on when we went through COVID, but I know we had to be very accommodating. At the end of the day, hey, if our customer's not making money, they're not going to be around and we're not going to be around. So I think, we probably had to accommodate on fees and just trying to make sure that they could stay healthy as well.
When the assets are built and are running, the downside to that is they depreciate through the years. How have you thought about maintaining the assets with the nature of the fact that they break down over time?
Well, that's a good question. We celebrated the 60th anniversary of Rimbey gas plant this year, and now we've spent, I would say, hundreds of millions of dollars on that gas plant, and there's not many components of that gas plant today that are pretty new. But when you buy older plants, you really need to maintain them, and especially some of these plants were sour, and that adds more complexity. And I think that was probably the strongest part of our business is our ability to operate and maintain these plants safely. I mean, safety is still number one amongst everything we do. But we bought plants from Imperial Oil up here. We bought plants from Gulf. We've got plants from Chevron. And with those plants came a lot of expertise. I mean, we kept, in most cases, all the operators. And we always said that if we could learn something with every transaction we did, we'd bring it into our process, into our maintenance. And even isooctane plant, AEF, Chevron and Neste did a lot of things at that facility, which is kind of a petrochemical plant that we draw it on at other plants. So, just constantly trying to learn and get better, but you need to spend money on maintenance at these plants for sure.
This episode is brought to you by Astro Oilfield Rentals. Distance can elevate risk, be it equipment failure, cash burn, or threats to your reputation. Astro Oilfield Rentals can help minimize those risks for you. With an impressive fleet of well-site trailers, cutting-edge communications equipment, expert technicians, and round-the-clock diagnostics, Astro ensures your remote operations stay productive from the U.S. border to the Arctic Circle. Astro Oilfield Rentals is there for you no matter the mile. Learn more at astrorentals.ca. And from the outside looking in, it would seem that midstream assets rarely go on sale. The stable nature of the revenues makes it a pretty desirable asset. But through the years, you've been able to just pick them up cheap. How did you think about that?
I wouldn't say maybe we got some of them early on at, based on today's prices very cheaply and what it costs today to build a big sour gas plant. They're probably into the billions,
Yeah,
whereas
exactly.
we were picking them up for tens of millions. I think that we were fortunate, but if you're out today buying gas plants, you're probably paying up. One of the things we've learned, if you hang on to a plant and the geology around it isn't there anymore, that plant, goes from being worth millions to, okay, let's demobilize and clean up any contaminants we might have around the plant. So I think if I'm guilty of anything, if we're guilty of anything, is we probably, in some cases, hung on to plants too long. There's cases now with consolidation going on where when we started, there were 300 or 400 producers out there, many of them small independents that really, really depended on us. As we consolidate this business, the producers maybe are a little bit less dependent on our gathering and processing. And, there's lots of them that do their own thing. You look at some of the big guys, Tourmaline, ARC, C&Q, they're very good at building and operating plants. And, we sort of built that into our growth model saying, we don't need to build every plant or own every plant out there, but there are going to be areas where we can add value by having our independent plant. But we've probably focused a lot more on the downstream. I mean, we have a huge position at Fort Saskatchewan and with our acquisition of Plains, we're a lot more focused on the fractionation pipeline marketing of products and maybe a little less so on the gathering and processing, but doesn't mean we won't build or buy more gathering and processing plants, but we understand that in a consolidated area, some producers are going to build their own, and they're very good at it, and we don't have to go in and compete with them in some areas. We're comfortable that if we do the other parts of our business right, we'll get their barrels into our pipeline and into our fractionator.
And in the era of tight regulations on pipelines with very little room to expand, what's the biggest challenge or the engineering hurdle that Keyera faces with roughly 4,000 kilometers of pipe? How do you think about that?
You want to maintain the ones you have in the ground because it's difficult and costly to put new ones in, and we've found that out with the building of caps. I mean, our team did an excellent job, but us probably over 500 kilometers, with 2 pipes in the ground, cross a number of big rivers, through areas where we had a number of environmentalists, looking for nests in trees. And I'd say we went through that, and it costs you money. It costs you money to build those. But, at the same time, we got it on stream, and our cost was a little higher than we wanted. But overall, I think it was a tremendous project. And we actually got complimented by the Premier for the lack of problems and a lot of hard work. And we had something like 18 different indigenous groups we were working with. I think we had 16 or 17 indigenous companies that did work for us or own companies that did work for us. over $250 million went into that. So we did it right. We looked after the people that were along the route, and we continue to do that. You're trying to have those relationships with those communities as we work through and start filling up that pipe.
Brownfield or greenfield? Which one do you prefer?
Well, we've had most of our success on the brownfield side. We bought wonderful assets in the right locations. And these were assets that were built by the majors, in some cases, 30, 40 years ago. The Exxons, the Chevrons, the Gulfs, the Shells. Those companies decided that, they all pulled back from Canada. And they left assets with, I always say, a lot of meat on the bone. And so, you can buy the right brownfield assets from a major that's made a decision to leave the basin. Chances are you're going to get a good asset. So we've built some things, and I think we've learned along the way that, hey, we got to work at being better at building plants and pipelines, but we're not afraid to do it. It's just that, today's world, it's become very expensive to build bright, shiny new gas plants.
Keyera produces isooctanes and other products like propane and butane. How do you foresee these products in the mix with the push for cleaner energy solutions?
Well, I think isooctane, for one, makes your engines run with less pollution, a higher octane. So there's a little bit of an environmental friendly push to that asset. I think the reality is that the world needs a lot more propane and butane. So today, our propane goes out of the Gulf Coast probably to markets in South America and Africa, where they're using propane and butane to cook their food, and better than the dung that they might be burning inside their huts. I think propane and butane are assets that are really needed in the third world to bring them into the next level. They don't go from burning wood to renewable energy overnight, and there's a step there. So I just think that Western Canada, we're going to probably see another 3, 4, 5 BCF a day of gas developed here incrementally to what we produce today, which is maybe 18, 19. And along with that's going to be maybe another 500,000 barrels of NGLs. That's our belief, is that how do we get out in front of that with infrastructure? I always say we got to get where the puck's going to be. Maybe it's the hockey connection, but I think midstream is kind of like that. You'd love to have a gas plant in an area where there's going to be development, i.e. the Montney or the Duvernay, and where that's going to go. Same with infrastructure to move these NGL barrels away. You try to get into place. And I think our acquisition of Plains is a little of that. We believe markets in Quebec and Ontario, especially the northern part of those provinces, are going to continue to use a lot of propane and butane because it's hard to build pipelines, gas pipelines through bedrock. And so it's a new, fresh market for us and our customers that we're excited about. But it's just trying to stay ahead of where you think it's going. And today, that's hard to do because technology's changed the game so much for the better. Technology alone makes our infrastructure business that much more valuable because that they're going to continue to have major success growing that technology in the Montney and the Duvernay, and producers are going to continue to drill as long as those barrels are worth, they're very valuable. Today, drilling in the Montney and the Duvernay, probably 70-80% of the value is coming out of the NGLs, and the rest gas. So it's important that we have that infrastructure ready for them so they can get maximum value for those products.
Canadian producers have had to bear the cost of the heavy differential on oil prices and also very weak natural gas prices. If you were to suggest ways to close those differentials, what would you say?
I would say, the new government direction would be
build more.
I would go west. Go west, young man. I think more LNG off the West Coast, knowing that Asia will consume it. More propane barrels, butane barrels, oil barrels. I think it sends a message to our friends in the South that we can rely on other markets. And it's maybe harder to move those products out of the East Coast, but we got a lot of pipe to Toronto and Quebec, and maybe even supplying more gas into those worlds would be beneficial. Certainly let places like New Brunswick and Nova Scotia utilize their wind power if they had backup gas. But I think we'll always have a differential until we have more markets, more varied markets. And I just think we've been handed a great opportunity here to go to the West Coast and start up of LNG Canada. Love to see phase 2 announced. Love to see other LNG projects go as well. And I know with the capital that's being spent on terminals out there that you're going to see a much bigger volume of NGLs go off out of Prince Rupert and maybe other products. So it's an exciting time, but we'll always face that. I also think that our basin's early days in its development, and we're probably going to start to see some U.S. basins tire out a little bit. I hear people down there talking about, we don't need your energy. They need our energy, and they're going to need more of it. But I think we should always have options to go somewhere else too.
Between developing the deep basin with storage and gas processing and fractionation compared to expanding to LNG out west and all the other parts of Keyera, is there a part of the business that excites you the most?
Well, I love the gathering and processing side of the business. I spent 20 years of my life on the E&P side. So, that's the successes that producers have had over there with technology and where that goes is very exciting. I think the Fort Saskatchewan area is got huge upside. I think we've got the ability to build more petrochemical plants there. I just think we have to get the outside capital markets world and outside US and European and Asian capital to understand what we have here and support the expansion. We went out many years ago and bought 1,300 acres in the middle of the Fort Saskatchewan industrial hub area because we were so confident that this is going to get developed, and we wanted to own this land. And it sits there today, and we've started to develop it with some terminal business, but we really do believe there's room for a lot of petrochemicals because we're going to have some of the cheapest gas in the world in this basin. Even at $3.54, producers are going to find a lot of gas. At that price, I think petchems like Dow's expansion that they're talking about that have pulled back a little bit, but I think that's the start of what we could see up there. Diversify. I think Peter Lougheed was always very proud of the fact that he brought the petrochemical business to Alberta when they started to strip ethane out of the gas streams, leaving the province at Empress. And so we have Joffrey and we have the petchem business that we have at Fort Saskatchewan because of that. So I think we could see a second or third phase there, which would be very exciting.
And when you look out to the capital markets outside of Canada or in Canada, and you present the value of Keyera, it's pretty big now, but its plan is to grow. How do you sell the company on its value proposition now? What do you present?
Well, we've always had a pretty steady cash flow stream and growth. I mean, even through COVID and some of the downturns, we've never cut our dividend. We maybe slowed it down a little bit, but we continue to grow our cash flow per share and raise our dividend. We feel this acquisition we've done, is going to really allow us to continue that growth. I really believe that our team is going to be able to find some significant synergies and make these assets sweat. I think we understand them. I think they fit like a glove with what we already have around. We see this acquisition as a real growth vehicle for us for the next 2, 3, 4, 5 years. And there's lots of work there to integrate the people and the assets.
And maybe for the listener, what was the last acquisition that Kiier did? Yeah.
Oh, that was $5.15 billion acquisition of Plains Petroleum's Canadian NGL assets, which encompasses NGL pipelines, mixed pipelines, fractionation, storage at Fort Saskatchewan, straddle business at Empress, pipeline from Empress to Regina and Winnipeg with markets along the way and storage, access to Enbridge's pipeline that moves NGL mix down to Sarnia, where we have purchased a 90,000 barrel a day fractionator there, as well as storage and access to that whole Eastern Canadian and Michigan market. So there's a lot of work to do to execute on that acquisition over the next 2, 3, 4 years.
And would a simple way to describe Keyera, some of its assets be a product that is very hard to replicate and that you can't just go build tomorrow, and as a result, you'll have a very stable cash flow that's growing? to the years?
Yeah, I'll put you on the road tomorrow. No, that's exactly it. I mean, the Edmonton assets that the infrastructure companies own, sit in the middle of Edmonton, and so we've got 6 pipelines that run from there to Fort Saskatchewan, which is 20, 30 kilometers away, through pretty tight areas, moving NGL mix, propane, butane, condensate, and to go out and replicate those assets, if it's not impossible, it's going to be very, very expensive. Caverns don't get built overnight. Each cavern we mine probably takes 2 to 3 years. We've now working on our 19th. We have land for another 100 if we wanted to on the 1,300 acres we have. And then the fractionators are all tucked in there between Dow's facilities and ourself and Plains and Inner Pipe. So to replicate these assets is very difficult. And I think it's not impossible because some of the young, aggressive midstreamers have built assets and they're good at it. But that's the competitive advantage we have, is we're already in some very strategic places that some assets will never be able to replicate.
On the other hand, the critical investor would say Midstream has a pretty strong proxy to oil prices. Post-pandemic, the share prices of Kiier have recovered really well, but during that period, it was a real tough time for the company. How do you present the company in that aspect?
Yeah, it's a great question. And, when we started, we always said, we're not going to have the volatility of an oil and gas company. And so if you look back, we'll get pulled down when we have a black swan event like COVID or financial crumbling, but even soft oil prices, and let's face it, we've had terrible gas pricing here for the last 4 or 5 years, but we never take the big dip that they do. We're a lot more stable cash flow, and I think because when a producer has a gas well, they got to get some really ugly pricing before they're going to shut that in, and so they might slow down drilling, but they need to have cash flows as well. So we will follow some of those cycles, but I feel like we'll never dip as low and probably never go as high. We don't get the advantage of $100 oil or $5 gas either. We're cruising along there at just a more conservative decline.
Maybe as we get towards the end, some reflections on your career?
Okay.
As CEO for 16 years, did you view the best deal as a win-win sort of deal, in that you're probably going to meet these counterparties again down the line?
Oh, absolutely. Yeah, I don't recall a deal where I felt like, oh man, we won this one. With the producers, there had to be give and take and win-win. Like I said earlier on, we're only in business if our customer, that producer, is out there making money and doing well. And I think we made some acquisitions where we thought we got acquisition at the right price, but the people on the other end wanted to sell that asset, and we happened to be there at the right time.
A lot of people look to you for advice nowadays in the industry, but along the way, who did you study from and who did you look towards?
I look back, some of my early models were hockey coaches or teachers, that believed in me. But I had the opportunity to work for some great people, starting at Aquitaine and Cantera. But I think my first sort of real exposure to a leader was Al Markin at Poco. And, Al was just hard charging. And I really respected him because he went for it. He just went for it. And I know Al today. I was at his 80th birthday recently, and he's a wonderful man. And I love to talk to him still about the world because he's got a unique perspective. I worked for John Hess out of New York, and he came from a different world, born into a billion-dollar family, but hard worker and just smart and intense, very intense. But I think he made me a better leader because, boy, you better be prepared when you walk in to his boardroom in New York City to present to him. I just, I met good people at Gulf, but I would say I learned as much about leadership from my peers, the Dave Smiths of the world, and people that worked with me at Keyera. So, and sometimes you will learn a lot about leadership by watching people that work for you as well. So,
Advice to a 30-year-old Jim Bertram. What would you tell him?
I guess when you look at where I'd say very humble start in life, small town Saskatchewan, never say never. If you have passion and you go to school and learn, but when you get into business, that's when the learning really starts. So I always tell people, you never stop learning, and I've learned from great leaders. I've even learned some things from bad leaders because you learn what not to do. I think you got to be positive. I might be often called the most positive guy in the world, but I believe in people but I believe in hard work. And I tried to make our culture at Keyera a team culture. We hired lots of athletes because I know athletes, as I always used to say, like get out of bed after they've had a defeat, and business isn't about winning every day. So we built that, I think, winning culture that way. There's no magic bullet, but I just think Calgary and Alberta is such a wonderful place to have a career in the energy business. If you don't like what you're doing, there's 50 other companies out there that'll give you a job, and companies don't look after your career. Look after your career yourself. Sometimes companies love you to stay in one spot too long, and they don't think about moving you around, and everybody has a different pace they want to be on. But for those people that want to go fast and learn, you have options in this energy business, great options. So that's why companies need to work real hard at keeping their people. By keeping their people, giving them opportunities to grow their careers, or they will move someplace else. And I found that's probably what allowed me to have the success I did. I wasn't afraid to move around and be very positive. Be positive. Nobody gets ahead in this world, I think, coming to work with a black cloud over their head. People want to be around people that are full of energy. And I have a good friend, Grant Fagerheim. Be a Grant Fagerheim. Be charged up all the time, everywhere. So that's probably the best advice I could get.
I really appreciate your time today, and a quick shout out to Marty Staples. Thank you for connecting with us, Marty.
Well, Marty's a very successful young businessman, and I could learn lots from Marty as well. And Trevor, thank you. I appreciated the opportunity to tell our story.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. Until next time, happy coffee drinking.